Welcome everyone to episode 1 of today's Dealmaker series. My name's Kris Corns and I'm the Operations Director at Crystal Specialist Finance, and it's my absolute pleasure to be hosting this brand new series today. This new series of webinars from Crystal Specialist Finance aims to take a deeper dive into some more deal specifics and to give our broker audience a better understanding of how a lender will look at a deal, all with the aim of us identifying more opportunities and ultimately submitting and completing some really good business. So if any of the attendees today have any questions during the webinar, please use the Q&A button, which should be at the bottom of your screen, and we'll do our best to cover them during today's what is already a very packed session. So over the course of this series, we're looking at each of our specialist finance sectors in detail. And today we're starting with development finance. And of course, the specifics of deals only works if we have some real experts to guide us. So I'm delighted today to be joined by Peter Howarth, Credit Risk Manager from Mint Bridging, Ian Pickering, Head of Development Funding from Together, and Crystal's very own Development Finance Specialist, Adam Tauber. Morning, gentlemen. Thank you for joining us today.
Morning.
Morning, Chris.
So going straight into it then, Peter, just how busy is the development marketplace at the moment and what type of deals are you seeing currently?
Okay, so firstly, thanks for inviting me to speak on this webinar today, much appreciated. We've had some encouraging signs in 2021. Obviously, 2020 was a difficult period for most people in a challenging environment. However, from what I'm seeing is the development sector appears to be positive at the moment, pretty robust. There's plenty of developers out there who want to build and need access to finance. So, we didn't stop lending in 2020. We carried on right the way through, and that pipeline has continued into 2021. 50% of our loan book is now aligned to development finance of some description, be that refurbishment or ground up. And applications this year, okay, and on last year was a bit quieter, but certainly a 100% increase on the same period last year type of thing. So we've expanded our team. We've brought some new people into our development underwriting team, and we continue to expand our portfolio management team. So yeah, it's been a pretty good start, and the products that we're being asked to lend on are wide and varied. So they go from simple, so we say no structural works, a simple tartan turn as we know in the industry, new bathroom, new kitchen type of thing, straight through to houses being converted to HMOs with an extension on the rear maybe. We've got ground up developments of 2, 3, 4, 5 houses, 6 houses type of thing, and a number of office to residential conversions. So yeah, it's been a good start, and the ask from the customers is quite varied.
Excellent, thank you. Ian, what are you seeing there?
Obviously, Peter's just mentioned Mint through 2020 and the lockdowns. They continued to push on. Together's position after lockdown one will be familiar to most of the audience today, I would imagine, where we took a conscious and logical decision just to pause lending to a degree and focus on our existing customers in the back book, not an insignificant book at £4 billion. So the amount of new developments that we funded throughout 2020 was fairly modest. We just checked paused some of the pipeline we had and took stock more towards the summer. And it was only towards the back end, Q4 of 2020, where we really made a strategic decision to proactively get back in the market fully. The book was in really good shape. We had some fantastic results during 2020 with completions of sites, sales coming in, good values being achieved in line with valuations, and in some instances beyond that. So there were positive signs there from the customer base and from the market itself. So since we've really pushed forward back in the market, fair to say that we've seen a good, steady and increasing pipeline of inquiries. The offers that we're putting out there, we're getting much more traction the last few months. Pipeline's growing. In terms of typical transactions, I would say that the bulk of what we do is in the range of £500,000 up to £5 million of debt. Predominantly residential sector based, be it new builds, ground up, conversions, few PDR schemes in their office to resi. We're seeing a few more smaller industrial schemes, the smaller starter unit type trade counter stuff, which in years gone by probably wasn't, on too many people's appetite, but there seems to be good demand in the right locations for those. So we've seen a number of those. and even a few smaller commercial deals where we've got strong pre-lets in place with the likes of Costa, Starbucks, Greggs, Lidl. So we're seeing some positive stuff there with them de-risked with a strong exit strategy in place.
Thank you. Adam, what are you seeing from the Crystal side of things?
Good morning all. Personally, I'm extremely busy, not enough hours in the day, to be fair. Currently, I'm working about 53 live cases with a total value of about £90 million. And just checking my inbox before I joined the webinar this morning, I've got about 6 inquiries upcoming overnight to get my teeth stuck into and in the morning. So busy day ahead. I think we obviously have an enormous shortage of housing, and it's difficult to see that changing anytime soon. Residential schemes of single and multiple units are the most common development deals that I tend to see daily. These deals vary between residential dwellings and blocks of flats. Touching on commercial property, there's been a rise in commercial to residential developments, and I expect this type of development to flourish as the year progresses. It offers an attractive proposition to most developers as it falls under, like Ian said, PDR permitted development schemes. And I suppose regarding the developer, working with all types of varied developers of all types of experience. So one thing that I would sort of like to highlight is it's great to see so many new developers taking that leap from small refurbs and renovations into ground up schemes. So look at continuing to support the aspirations of clients and developers.
Excellent. So certainly looking at a very positive picture out there then in the industry at the minute. So Ian, if I can start with you on this one. So clearly development finance is a really complex area. There's obviously a vast array of risk and underwriting decisions to assess. What are the specific areas that Together want to focus on most during this coming year?
As you say, Chris, a lot to consider, a lot of moving parts in a development project. A lot of technical stuff, which we've got a lot of experienced lenders in the team. A lot of technical stuff we'll leave to the specialist, the valuer, the QS to run through the formal due diligence stage. We've got some basic principles as a starting point that we tend to focus on initially. So looking at the customer themselves, have they got experience? What are they capable of delivering? And that experience we feel needs to be relevant to the context of the deal. So if they've been doing, residential refurbishment, tart and turns, as Peter mentioned earlier, and they want to move on to a 5-10 unit new build scheme, it's not necessarily the right sort of experience you would want unless you can de-risk that with the team that they've got in place and a contract maybe on a fixed price design and build. Secondly, the contribution, what's their skin in the game? We like that there's money at risk from them that ideally you get in at the front end, not just paper equity ideally. If somebody's bought well and added value, providing there's a decent level of contribution in their cash wise, we might be able to rely on planning gain. But we like to see, a decent amount at risk. And then how does that sit with our overall loan to cost and loan to GDV parameters and metrics, and tie in also with their exit strategy and the plausibility of that. And then finally, a big one for us, we're a big people business and relationships. Do we like them? Do we think we can work with these people? We see these relationships as partnerships. I know we're only in as a debt provider, not equity, but we want to build a relationship. We want the people, the clients, to feel that they can trust us, that they can open up to us. We're not naive enough to think that these projects are going to go swimmingly with no issues down the line. Near enough every deal we have has blips down the road, depending on what it is and the size of it. We want to work with these borrowers. They come to the table. These are the issues we're facing. This is what we've done or proposed to do about it. This is where we need your help. And, we work together on these things. So if we've got a starting point of those 3 fundamentals, then typically we've got a good starting platform to move forward with looking at a project.
Thank you. Peter?
Yeah, I think I would echo most of Ian's comments, well, all of Ian's comments there. I'm just trying to think of something to add on to that. So in Mint, we've got ambitious plans for 2021. We've rebranded in the last month or so as Mint Property Finance to help demonstrate our appetite to lend in all areas of property finance, not just the bridging sector as such. So again, we like to work closely with brokers. You've got to create that win-win situation with the broker, the customer, Mint, sure together we'll look at it the same way, and sort of getting the development request off on the right foot. So how's the broker, has the customer considered, what their loan to GDV ask is going to be, what the exit route is, and you might almost start at the exit and work back from that. And then it's looking to partner with the right broker, for example, Crystal, and then partner with the right lender, such as Together or Mint. So I think it's about getting off on the right foot. And I think for me, it's like having the right skills for the right job. So, if you want to design a ground up development and you're not an architect, then you might want to, employ an architect to provide some professionalism to your application, and sort of de-risk it as much as you can along the route. So, yeah.
Yeah, interesting. So it's much more of a people proposition than some other sectors of specialist finance.
Yeah, I think for us, we like to sort of champion the underdog, if that makes sense. So perhaps the individual who wants to have a go, not quite done it before, give us a call, chat through with the underwriter. Don't be afraid of doing that. We'll point in the right direction, and we'll marry you up with, for example, speak to our monitoring surveyor. Nothing might come of it, but they're willing to have a chat with you to position the cash flow, understand the risks of getting materials to site and the timing of those materials arriving on site, just to ensure that the development can proceed in accordance with the cash flow and the build program. Yeah, there's blips along the way. We know it's a wavy line, but if we try and set it up in the right way at the beginning, you've got a better chance of success at the end, I suppose.
Yeah, brilliant. Thank you. So Adam, listening to the way that the lenders there look at underwriting deals, what value can you add in the process from a packager side?
It's a really good question, to be fair. Now, I suppose it's sort of selling myself. So, having worked for two lenders prior, one being Together previously, and working in the development finance, I'd like to think I've sort of established myself as an expert in the sector. Keep up to date with industry news, legislations, lenders' appetites, and also property in general. I've got great understanding of what lenders look out for and what gets them excited. Insight into the application process involved, which hopefully sort of smooths out the application process and the journey of the customer. And most importantly, I've developed the knowledge required to, I suppose, assess a development appraisal in the eyes of a lender, and often find a way of structuring a deal that is attractive and credible to get the buy-in from a lender to ultimately produce competitive terms to the client.
Thank you. So it is a process of
providing sound advice is always appreciated, and that's free of charge, by the way. I don't charge for my sort of services. And my desire, I suppose, to help clients realize their ambitions is ultimately what drives me day to day. So cut me open and I bleed development finance.
Good.
Thank you for that. Hopefully we don't have to test that out.
Just touching on Crystal as well very quickly. Obviously, it certainly helps to have a brand like Crystal behind me. Crystal have established themselves as a real credible packager in the space, and is well respected amongst lenders. So I feel like when I send a deal, whether that's going over to Mint or Together respectively, they really do show eagerness and willingness to help out. Not to mention, obviously, the great service and response times that I get.
Excellent. And that's something that we can really offer to the brokers that are tuned in today as well, because if it's something that you are maybe not familiar with, or you've got a client that's doing this for the first time, then using the expertise of Adam, who can tap into the likes of Peter and Ian, is a real plus point, because it can mean that you've got confidence then going back to your customer that the information you're delivering to them is useful, factual, and is going to get them somewhere as well. So it really is a people business, and it's to take one of our taglines, it's about working together to make these things happen. So the next one then for you, Peter, many lenders' criteria are set in stone. So what's your approach at Mint to criteria? Is it more guideline or more tramline based?
Well, what I'll say to that is, yes, we have a website. Yes, we advertise loan to values. Yes, we have advertised pricing and things like that, and appetite in terms of debt quantum. What I would say is that we try to be as flexible as we can. As I just to reiterate, we like to champion that underdog. So, we assess applications on their own merits, and we try and get under the skin of the customer a little bit. So, for example, if a customer hasn't quite got the cash to do what they want to do, but they've got some assets in the background, we will be flexible with that knowledge. We're not saying we're going to charge those assets, but we'll acknowledge that those assets are in the background, and it might make us a bit more flexible in terms of the debt quantum that we can provide. So we're definitely not tramline, we are guideline and above in terms of our assessing of lending applications. We think we like to bridge the gap between that financial limitation and the long-term success. So we think because we've got the drive and the ambition to find a site, do some due diligence on the site, etc., etc. So we think that should be rewarded, and we'll do our level best to try and structure a transaction that makes the deal work. So very much guidelines and plus, really.
Excellent, thank you. Ian?
Yeah, similar to Peter, really. As you'd expect a business of this size, we've got documented criteria, lending standards, product parameters to shape the appetite and the loan book. With development, we talked about the various moving parts and all the risk considerations. So yeah, we take each deal in isolation, assess it, and put an offer out based on the merits of each individual transaction. So we do have genuine flexibility. A lot of that is often sought around loan to cost and loan to gross development value, but not purely on those. I mentioned before about where people have added paper equity through planning gain. So we sometimes push loan to cost above the 75% on the basis there's additional equity there. Loan to GDV might again be pushed depending on an exit strategy, if they've got a nailed or an element of pre-sales. Timing of customer contribution also, a lot of lenders like us, we like it in front end. Doesn't say it has to all be in at the front end. Sometimes we get some in towards an acquisition and then some into the build, whether that be at the start of the build or dripped in pro rata, if we can get comfortable with where the source of that cash is coming from. Peter mentioned other collateral they might have. We might cross-charge stuff, or we might, if they've got another site that we've not got charged, if we can get an undertaking or a lien over something that brings that contribution in mid-build, that's a possibility. We've done a couple of transactions where the client was confident on getting some pre-sales, so we set a loan to cost at the start with a trigger that said, if you achieve so many pre-sales that gets this level of value in line with the GDV and the valuation, then we'll ratchet up the loan to cost and the leverage on it. And once they've achieved that, we've then increased what we're providing, and actually in one instance we even backdated it to the start as well. So yeah, in summary, yeah, definitely guidelines and not tram lines.
Chris, I think just to add to Ian's comments there, I think everything starts with a conversation, doesn't it? So if somebody sat there in their home at their desk thinking, what do we do with this? Pick up the phone to Crystal, pick up the phone to Ian or myself, type of thing, or organisations, because unless we have a chat, we can't fully understand what you're trying to achieve. So yeah, just add that in, just throw that in.
That's a brilliant point, which leads me on to Adam. It must be really difficult with the flexibility that the lenders have got to remain on top of the appetite and the product guides from there. How do you stay on top of those?
Conversations, relationships, day to day. I'm talking to various different stakeholders, across lenders. First thing I do in the morning with a brew in the morning, as long as my little girl's not crying her eyes out, is look at development finance today and local press, and just keep a breadth of obviously the moving parts within development finance. But yeah, very similar to what Peter and Ian have alluded to. It's about conversations daily. The market is evolving. It's so fluid. Criteria does change. Appetite can sway. So yeah, ultimately it's making sure I'm having conversations daily and keeping up to speed with lenders' criteria.
Thank you. And can you give us a quick example of some of the flexibility that you've seen from a lender this year?
Yeah, so well, I mean, whilst I've got, Mint and Together on, it's worth obviously highlighting two deals, that both lenders are here today have helped me with, and both clients and I have been greatly appreciated for. So just starting with Mint, there was a December last year, a developer in some distress. The scheme was about 60% complete and needed further funding after the client had exhausted, his own cash. Typically, most lenders, I suppose, like to either be in from day one or come into a scheme nearer towards the end once it's sort of practically completed. However, Mint took a view on the deal and offered funding required for the client to finish off the scheme. So, again, sort of buzzwords really, it's, showing flexibility, willingness to look past, typical criteria and consider the case in its own merits, which Peter's, again, alluded to earlier on. And then on to Together, we had a deal for a purchase and a refurb of a large commercial office in central London. It was a well-established business looking to move their headquarters to. The loan to cost comprised the refurb, finance fees, as well as professional fees combined. Together, well, Ian looked at the deal, evaluated, all moving parts, client's experience, intentions, exit route, and took a view on the typical criteria of loan to cost. Structured a deal that was viable for Together as well as the client, and again, Together demonstrating flexibility, eagerness in supporting a customer, and I suppose living up to their sort of hashtag of sort of Together.
Excellent, thank you. So we've now had some questions that have come in from the attendees watching. So thank you for those. Keep the questions coming in. We'll do our best to pick them all up as we're on the call today. So the first one, this is from Carla. So Adam, I think I'll probably start off with you on this one.
Yeah.
I really want to get active, providing advice in the development space. How is it best to prospect or find new clients?
Well, I don't want to give all my secrets away. Carla, good question. Looking at your own client bank, I'm sure there may well be, or you may be sitting on some golden nuggets, and I think it's a case of just highlighting to all clients that you talk to that you can provide development finance, and it may well spark an inquiry or two. I suppose it's just letting your clients know there's additional sort of tools within your toolbox. And if you do spark inquiries, obviously make sure you think about myself in terms of facilitating them. Most clients who buy property investment will undertake some form of renovation or refurb, so often we'll look to finance and facilitate with finance. So let them know you can help. Another tip would be social media. I mean, I'm a massive fan of LinkedIn. It's not for everybody. But engaging and raising your own profile, connecting with property developers in your local area is a great way to increase your network and hopefully generate new inquiries.
Thank you, really helpful there. Ian, Peter, anything to add to that?
Yeah, I think all great ideas. I mean, just a couple of things to throw in there. I mean, in the Manchester area, there's a lady who delivers an online forum every Wednesday without fail at 7 o'clock. It's apart from over Christmas and things like that. She finds something to talk about, and it's always got a development angle to it or a refurbishment angle to it, and those are things whereby you can join there and learn about development finance refurbishments. She has like gas engineers on there, electricians will be talking for 20 minutes, and bit by bit you can piece together. I have a good idea for how to assemble a refurbishment maybe, or a house or HMO over a few weeks. So there's online forums and things like that. I think people will be surprised if you look at your contacts in your smartphone these days, how many contacts have you got in there. So if you can be selective in who you approach and give them a nudge type of thing. And one thing that we found successful is, again, being a bit selective, but send a contact a small gift or something that they'll remember you by. Say, oh yeah, I need some development advice, and such a body sent me a bowl of fruit or something, or whatever it might be, or a mat of some description. with a name on. So just things there to jog people's memory and things like that.
Thank you. Ian, anything to add to that?
I think the guys have mopped it up well there.
Yeah.
I think Adam's best placed, obviously, being one of our packages to advise on that, or else, you know, if we knew all the answers, we wouldn't be using you guys for business. But I think once you engage with these people's and with these potential clients and you've prospected them, just having the knowledge and insight as to what the core lenders, what their sweet spots are, what the parameters are, what you can, just having that product knowledge to be able to give you a bit more credibility when you're talking to them. Obviously, social media has been mentioned, which is a big one. There's obviously not a lot of networking going on face-to-face these days. You can get planning data direct from the local authority if you want to put the legwork in, do that, or you can even find companies that will harvest the data. So, you know, people could do targeted marketing to those sorts of, with that sort of data. And finally, one thing that the founder of our business has worked well with over the years, but this one, which everybody's cup of tea, but you're driving past a building site, calling in and asking whose site it is, finding the details, canvassing them. Look, you're probably too late for that deal, but you get a subsequent one. You know, you've shown an interest and get an early dialogue, you might be in with a shout. So that's probably all I've got to add.
Thank you. Some really good points there. And we've also seen a number of our buy-to-let landlords getting involved in refurb schemes, and then a refurb leads to a heavier development, and then a heavier development leads to a full-on ground-up development. So I think you can't underestimate your existing client bank in there as well, because there'll be something that someone wants that they might not know that you do. I'll give an example on a number of these talks. I was in a room which feels like a long time ago now, and we were talking about commercial finance, and there was someone in the room, mortgage broker, that had an office above a greengrocer's, and he brought up an example that the guy that owned the property went to someone else to get a commercial mortgage because he thought that the guy that he was renting a room to only did residential mortgages. So it's very much making it clear to your clients that you offer the whole spectrum of specialist finance, because you never know when something might come up. And so we've had a very specific question come in this time, so bear with me on this one. So Scott has asked, he has an experienced builder who's running into difficulty completing a site of up to 30 homes in Lancashire. So half of the units have been sold for 200,000 each. 5 more have been reserved at 200,000. However, he's short of £1 million now that he's run out of cash. His current fund is refusing to advance any more money and actually wants the existing debt repaid within the next few weeks. Is that something that you'd be able to help with? Ian, you want to start us off on that one?
Yeah, sure. I'll just confirm your understanding. So they're in at 1.5, need that day one and a further 1 to finish. We've got a GDV, so we've got 30 units at 200 across the board, I'm assuming. So 6 million GDV, of which 3 million's exchanged, further 1 million sold subject to contract, and a further 2 million to sell. Yeah. I suppose from a purely numbers basis, it looks a strong deal financially. The key metrics we'd have, but imagine the site value there's got to comfortably worth, I would have thought £3.5 million plus, just from the top of my head. I suppose our starting point with that would be, why is the relationship broken down? Is it down to the lender running out of money, or is it something that the lender's not happy with the performance of the borrower, the developer? So we'd want to get under the skin of that, I think, primarily, and understand that. We talked about before, people that have got experience, the capability that you want to be able to work with and have a relationship when things become challenging. So yeah, we need to get under the skin of that and get comfortable with that. I think if we're okay with that side of it, probably need to understand what they paid for the site and when, and what they've spent to date. So with that and the debt level they've got, we'd understand whether they've got any skin in the game. What's the remaining build program? Are they self-managing it? Is there a contractor involved? Is the contractor part of the problem? Aside of the cost to complete at $1 million, are there any other outstanding creditors that we've got to factor in that need paying or might cause a problem? And then we need to look at probably the regulatory side. So is building control okay, warranty provider, planning, etc. But those are probably things you'd look at further down the line. But I think if you could get comfortable with the reason for the relationship breakdown, there's probably a good starting point for a deal there, I would think, obviously subject to your your standard due diligence, QS valuation, etc.
Thank you. Peter, anything to add on that one?
Yes, I think Ian's covered off the majority of how we would look to review the application. Just to basically add to that, I suppose, what we could do in Mint potentially in order to demonstrate flexibility. Or speed is of the essence here. We've got 3 weeks. So was it 2 or 3 weeks or a few weeks?
Yeah, a couple of weeks, yeah.
A couple of weeks to try and provide some funding. We would ask for the valuation report, the one that's already been completed. If we can get hold of that, we would potentially use that as a base of the valuation. We might want it readdressed to Mint, but essentially we could potentially use the valuation to save some time there. Obviously, this follows a hastily arranged credit committee meeting to make sure we've got the appetite, but for valuation. And then at the same time, we could instruct our monitoring surveyor. So we've got some SLAs, some service level agreements for our monitoring surveyors to make contact with the customer within 24 hours. So that could be the same day, essentially, to set up a meeting and discuss the project through and discuss some figures and what the end game is going to be. So we can instruct the value or get the valuation, instruct the monitoring surveyor at the same time. And additionally, we can get it into legals. We would work with the borrower or the applicant to make sure they're comfortable with all that. Because they will have to sign a cost undertaking for the various professionals. But essentially, we can spin all those instructions at the same time and make sure that the whole team that was assembled are aware that the deal will need to complete in a few weeks' time. And that might mean some overtime late on the evening or maybe a Sunday or Saturday morning type work. But essentially, let's try and create that win-win and proceed with haste, covering off all the main points that Ian covered off there. So yeah, flexibility.
Excellent. It looks like the first deal made on the Dealmaker series. Excellent. Thank you for sending that in. So Adam, just directing this to you for a second. Do you see many transactions like this where we might be part way through the transaction or the initial plan maybe didn't go the way it should have done?
Yeah, I do see a few, to be fair, daily. And I think that's probably, no disrespect, but I think it's developers, sort of early on in their property journey, where perhaps, just due to knowledge or know-how, they're falling into, a situation which occurs, on a part completed scheme or they've run out of cash. I think, what sort of Peter and Ian have sort of talked about today, I think the biggest thing really is due diligence. I have conversations daily, about, development schemes where, we really need to understand, who the contractor is and make sure they're credible. Because often, it's a case of, where Jimmy up the road, who's often take the build program, where he's driven down the costings and it doesn't really stack up to be validated by lenders QS. The pound per square foot might be out. GDV comparables might be a little bit too rich in terms of where the borrower sees. So I think there's more and more schemes like this. But again, just hearing from the likes of Peter and Ian, that there should always be a home. It's great to know that lenders, do show willingness and flexibility to be able to structure deals. To try and work for a client, which ultimately works for me because I'm a business.
Excellent. And that brings me back to something that Ian said a little bit earlier on, where it's about ensuring that the fit's right. And I suppose that's both ways, isn't it? It's making sure that you found the right lender at the start that can see that transaction through, and then there's that dialogue all the way through, that if something does change, if there is a wrinkle, that there's, again, open and honest dialogue there that the lender can work with it to fix. It's about the lender finding the right customer, but also the customer finding the right lender for that particular project. Maybe not chasing the lowest rate or the quickest completion, but finding a home for the project, which makes it very different, I suppose, to bridging finance, where it's much more of a straightforward transaction type at times.
Absolutely, yeah. I suppose it's my initial conversation with broker client is understanding what the key drivers are. What is it rate? Is it flexibility of the lender that can hold your hand almost throughout the process. So understanding what the key drivers are enables me to be able to fully assess where I would place the deal, and understanding the lender's criteria is key to be able to identify exactly which lender it fits and marries up with.
Excellent, thank you. Peter, I'll start with you on this one. So Sean's popped a question on there. What are the typical costs associated with development finance? So rather than putting you on the spot about product, etc., just the typical type of costs that a developer would be expected to see.
Yeah, all go into specifics because I think every fee is dependent on the size and the complexity of the loan, but typical fees are, you obviously got the valuation fee, you've got the interest rate for the loan, you've got the initial Morrison Surveyor's report. In Mint, we have a dual Morrison Surveyor's report, so it's more of a ground up of one house. We'll have a lighter report to save on some costs, whereas a sort of 5 or 6 houses will be a full-on initial report. We then have the interim report. So when a developer calls for some funds, and we'll send the Morrison Surveyor out. They'll meet the customer on site and provide an interim report. There is a loan arrangement fee that you would need to pay. Sometimes there is a monthly retention release fee. So if you ask for a retention release of £50,000, whatever it might be, for processing that transaction within the lender, there is a fee there. I think that covers off the main ones from a finance point of view.
Thank you. Ian, anything to add to that?
No, I don't think so. I'll keep it consistent with Peter and won't quote specifics, but yeah, arrangement fee, interest on the debt, whether that be roll up or serviced. Our legal costs we add to the facility with title insurance at the outset as part of the day one gross lend, exit fee on redemption, monthly a drawdown fee, processing fee for each stage payment, the direct costs, and then external costs being, as Peter said, the valuation and the QS due diligence and drawdown monitoring reports. So just the same, really.
Yeah, thank you. Adam, is that consistent pretty much with the other lenders in the market?
Yeah, absolutely. Yeah, and I think my job, is once I've achieved terms, it's to talk through in granular detail, just so there's understanding of exactly what that facility looks like. It's I suppose I've presented visually different from the lenders that I work with, and I think that's probably the biggest challenge for me is rewording, understanding, and be able to deliver transparently and informed facility as all encompassing the terms and fees to brokers and clients, so they can understand exactly the financial means of a deal. I think one of the other things I would just add is when we look at sort of fees, often I do find that some lenders will charge for their own contingency inside the facility. So again, that's just something to bear in mind, that should a lender have to step in, there's sort of a little bit of a bumper involved within their facility should they have to utilize a contingency fund. Which often isn't always added in on the front line for a developer. And again, that's a conversation for me to have and just make them aware of it.
Okay, thank you. And I suppose the cost of finance are just another cost of the project, aren't they? The same way that materials would be, or the labourers that are on site. So it's something to factor into the overall profitability of the deal from the client's point of view. So Sean continues to say, again, another deal scenario here. We have a client who owns land with planning approved for 5 retail units plus 2 stories of residential directly above. So there we've got a mix of resi and semi-commercial, 15 units in total, GDV confirmed at 3 million and build cost of 1.6. Sean asks, how should he best present this opportunity and what kind of terms would he be looking at in the market? Ian, do you want to start us off with this one?
Yeah, sure. Similar to the earlier conversation we had, I think, initial fact find, some key information we need. Before I get into that, I'll just give you an example of something of the day that only earlier this week, I was sent inquiries from the owner side. They told me the GDV was just over 10 million quid. They wanted 65% loan to GDV, which, put it at about 6.5 million quid, including the interest element. So the capital was probably around 6 million quid. Asked a couple of basic questions, and it turned out that the purchase price was less than 2 million quid in total. The build costs were at 2 million. So the facility they wanted was actually giving them cash back on what their outlay was. So there was just nothing in it, and they were taking profit out early doors. Now, they probably bought it got the planning added value. So in their eyes, they were just taking out the value they created. But something like this, you've got the GDV, you've got the cost to build it, but what did they pay for it and when? So we can understand whether there is a contribution in there. What's the current value anticipated at? What's their experience in the sector? How they're going to procure it and tie that into their experience. Are they going to be self-managing it? Are they going to be bringing a contractor, putting it out to tender? Nature of the contract that they will engage with. What's the build program and exit strategy? Is it a retention? Is it a sale? Is it pre-sold? How long do they need the facility for? So we can then assess the roll-up interest that you would assume they would need. Copy the planning consent and planning, and ideally a financial appraisal, including a split of the GDV. So how much of it is residential and how much is the retail? The retail, if it was speculative and they've not got a nailed on exit, you'd probably just stressing that a little bit in this market. Not the most buoyant sector to be in, but just understanding a little bit more bigger picture. I think those are the key facts that probably any lender would want to look at initially. So I think that's a starting point to do a desktop, and then from there you can, if you've got a starting point to issue some terms and a level of funding, you can then get out and meet the customer, see the site and the whites of their eyes.
Excellent, thank you. Peter, anything to add to that one?
Yeah, I mean, that's a great response from me in there. So we will do something similar. Just to add to that, I think when presenting to a lender, to increase the chances of success, it's, for example, do a bit of location search, research the locality. What's the micro economy looking like? Are you building the right homes, for example, in the right places for the right people? And then you go to, you shouldn't have problems in trying to find a willing lender. When I look at transactions initially, it's fairly basic, but it's amazing how many times you get an application through, say, with the wrong postcode on. So, we all go to Google Street Maps or whatever you use, you put the postcode in, you think, this looks nothing like what I'm being asked to fund here. The locations doesn't seem right, Mr. Underwriter, Mrs. Underwriter, can you just check the location? So it's just like some of the basics sometimes that just helps the application move along. An asset and liability statement would be good if it's from the applicant. Again, we'll just help to demonstrate our flexibility and mint if when we're looking at applications. And then the other thing will be actually the actual liquidity situation. So come back to a point we made earlier in terms of the cash flow. If you're going to put some cash into the transaction for the cash flow, that's for argument's sake, say £50,000 to start with, then you want to do a retention release. Okay, so what's the timing of that retention release? Is it when you spent 40 and you want mint to come out, or together to come out and do an interim report, or is it when you spend the 50? Because you have to keep the site going while the monitoring surveyor comes out and do their reports. And it's probably about a week there, maybe, from the monitoring surveyor coming to site, we mint all together getting their reports and then releasing the funds to you. So some customers don't quite get that. They think once the monitoring surveyor's gone out in the morning, by the afternoon, they've got the money in their bank account. So it's just something to consider, isn't it, in terms of the cash flow requirements. And again, it comes back to having the right skills for the right job, isn't it? Sometimes if you're inexperienced, probably on your first 2 projects, you might want to employ a project manager. Might cost you a bit of cash to do so, but they'll get you over the line and get an end product for you, rather than perhaps sometimes trying to feel your way through it yourself and then delays occur. So and then further down the line, once you've got your experience, perhaps you can just do away with 1 or 2 of the professionals that you've instructed to present that case to us.
Excellent, thank you. We've got lots more live questions coming in, so thank you everyone that's sent in questions so far. We will do our best to cover them in the next 10 minutes or so. So Adam, if I can direct this one to you, what's the development space like for a builder with no experience in development but wants to start his own projects?
Well, there is space. I think for me personally, it's I love a challenge, and I think it's well received nowadays by lenders who are showing that they're not as rigid in terms of experience of developers. So more and more, are coming to the market and taking that, sort of a leap of faith in terms of progressing their property journey by getting involved in, larger, development projects. The biggest thing would be obviously, like again, Peter and Ian have talked about is if they don't have that experience themselves, then we really do need to look at a real credible contractor, that has like for like relevant experience that the lenders can feel comfortable with. Ultimately, the lenders are investing in the borrower. So they've got to have some level of comfort within the borrower, but ultimately, we've shown today that they will look past that and consider the experience of a contractor. So yeah, my advice is if it has to go to tender selection and you run an exercise in terms of procuring the right contractor, it's well worth doing, because then you've got more chance of actually placing and sourcing funding through a lender.
Excellent, thank you. Anything further to add on that one, gents?
I think I'll just add on that. I think it's about teamwork, isn't it? I think if you view the customer in the middle, and you've got all these professionals and Crystal and Together and Mint, leverage that knowledge there to make the transaction work. Just by way of example, we had a transaction last year. It was a build of one ground up. They had no experience at all, but we supported that customer. And our monster surveyor goes out type of thing and chatting through and said, have you considered a new build home warranty? Because you're going to sell this house, somebody probably need a mortgage. They're going to want a warranty. They hadn't thought of that. So there you go, Mr. Customer, there's a bit of an add-on, and ask the questions on the monitoring surveyor. Don't be afraid to ask. Be like the underwriter or the monitoring surveyors when you chat to them, to just create that all-round better experience and get you more experienced and get it over the line.
Excellent, thank you. Ian, if I can throw this next one at you that we've had in. Sure. Sorry, thank you, Amit, for that question. That really good question. We've had a couple in on new build, on new developers. So hopefully that covers off a couple of the questions we've had there. So Ian, this one's coming from Stephen. If you were to cross-charge on other properties, is there a possibility of replacing those properties with funds raised through either refinancing or selling off units?
I'm assuming the refinancing or selling off of the units is the ones that have been cross-charged as opposed to the subject development. So if that is the context of the question, then yes. Can I consider that reactive at the time, or if there's a likelihood that will happen during the course, then we can consider that and try and build that in, and all things being equal type scenario condition. Those charges are taken, I suppose, in lieu of contribution, or maybe because the loan to GDV is a little bit rich. So, if they're fundamentally in there to cover one of those two aspects, which I'm sure they will be, if we can see that paper equity replaced by cash from a refi or a sale, then yeah, no issues with considering that at all.
Excellent, thank you for that. Peter?
Nothing to add to that one, really. Yeah. Chris?
Brilliant. Thank you for that one, Stephen. Adam's asked the question, do you offer development finance where day one the client can draw down in order to start the works and maybe put the constructor in funds to start groundworks, utilities, deposits, etc.? Peter, do you want to take that one first?
The short answer would be yes. We get a lot of applicants who may have already purchased the land, or their contribution to purchase the land means that we can do an element of forward funding. So we will help that cash flow out and provide the funds to get the site going, etc., etc. So it's called working capital is probably the phrase, isn't it? So let's look at the cash flow. Yeah, fine. You've got the land, or you've got some more assets somewhere. We will look to release funds to forward fund the site for you. What that means, though, is that cash has to be recycled throughout the development program. So you can't go off and go on holiday with it or buy a new car with it type of thing. It's got to stay in the cash flow, and we discuss that with the customer on each retention lease. So the short answer is yes. Yeah.
Thank you, Ian.
Yeah, similar to Peter, really. Look, if you geared up day one up to your maximum leverage and you're already at 60, 65, 70% on the site, you're probably not going to be wanting to put another 100 grand, taking you up to 80, 90% day one. But if there's an unencumbered site in there, there's room in your metrics, or as Peter says, there might be some other collateral you can take to cover it. Then yeah, it's a possibility. We've done that on a few. It's not something we do day in, day out, but again, it's about thinking bigger picture.
Brilliant, thank you. Adam, can I direct the next one to you? This one's coming from Mohammed. Are all development loans dependent on current equity in the property? So say the property is at high LTV at the moment and the clients want to do an extension and increase the value there. Is there any options for the customer?
I mean, most lenders look at their lend against the current value. So again, it's just about understanding, the actual development appraisal, understanding, where the financial, what they paid for it, what the current value is, what the build costs are going to be, and what the NGDV is, and I suppose working out a structure that not just fits with the client's financials, but also where works within the criteria of lenders. So yeah, I suppose there is ways and means, and I think we've discovered that today. We're talking to Peter and both Ian that no deal is looked at in sort of it's old school ways of being quite rigid. It's looked at how can we structure and make this work. So often there's workables to enable the client finding a solution.
I suppose additional security would be key to that as well. If there's any other property available, we'll try and pull some of that in.
Absolutely.
So just to add to that very quickly, we get quite a few requests whereby a customer might want to build a new house in their back garden type of thing, because the site location, the aspects of it seem to work to build a house in the back garden type of thing. Again, inexperienced developers usually. So we'll look at their house that they got, their personal residential dwelling, and we can usually from that make the cash flow work for them if they're willing to pledge some additional security, personal guarantee perhaps.
Excellent, thank you. So Chris has just posted a question. If a client wants to buy the next door property and then knock through to make one bigger property, is that something that you'd be able to consider? Ian, do you want to look at that one first?
Yeah, I mean, we wouldn't probably classify that as a pure development. It's probably not going to require planning, but if fundamentally you're buying an established property, so there might be an element of work, but it wouldn't normally be structured on a development facility for us. But as a business, we'd look at that. I wouldn't think there'd be a problem looking at it at all. There's an value of their property, they're buying next door, similar value, bit of cost to knock it through and bring it into one. Yeah, I would think we'd take a look at something like that as a business.
Brilliant. Thank you.
On that one, you just need to think of the title considerations. The two properties might have separate titles. So just something to get your lawyer to look at first of all.
Yeah, I'm sure they would. Yeah, I mean, we'd probably want to control both assets, obviously. We wouldn't want the next door one, the one they're in at the moment, staying with another lender, so you've no control of it. They've knocked through, and then you repossess something. You've got next door living with you. So yeah, definitely you need to be in control and understand the title position, as Peter says.
Excellent. We're running short on time, so we'll try and cover a couple of these off really quickly if we can. Again, Ian, we'll start with you with this one. What's your appetite in the shift to more modular homes, so modular, eco-friendly, sustainable developments, etc.? Is there any thought around those at all?
We've done a handful. I think they're still emerging in the market. I have to say that people that are looking at this type of property tend to think they're coming at a vast premium over and above a direct comparable next door that's not an eco type. And we're seeing that when the valuation comes through, it's not reflecting of their views on life. It might make it more appealing, sellable in terms of the buyer wanting to buy one, but are they going to pay, you've got £500,000 property next door, they're going to pay 50 grand extra because it's got low domestic bills. seen more modern methods of construction, and again, that's something that we will support if we're comfortable that the warranty market and the mortgage market is accepting of that method. You know, they still call the timber frame modern method of construction, but it's been around for donkeys longer than probably most of us. So, but yeah, we'll look at them. I think people's expectations are just sometimes a little bit optimistic.
Thank you. Peter, anything to add to that?
Nothing to add to that really, other than perhaps just bolt on maybe you know, the energy performance certificate of the property. I think I saw some news a couple of weeks ago. Some lenders now are offering cheaper rates if you've got an A or a B EPC. So again, it's just something to bear in mind as you're building your to build your house and how efficient it's going to be in terms of cost going forward.
Excellent. The last two bits before we wrap up then. So very quickly to you, Peter, these questions have come in on specifically for Mint. The Mint website advertises lending in Scotland coming soon. Any idea of when soon is?
I'm not going to commit myself to when soon is. I think 12 o'clock today or something like that. My CEO might just assume if I said something like that. What I would say is that Mint has rebranded in the last month or so. We've gone to Mint Property Finance. We're looking at all our products. We're going to do some product launches in the next few weeks. So they're kind of oven ready now, just waiting to wheel them out. So unfortunately, I don't know the exact date, but I think it's more a case of watch this space and keep an eye on our website.
Okay, thank you. There you go, Bill, one for you there. And Maria's asked if you've got a link to the lady in Manchester that you were referring to earlier.
I can, if somebody wants to collect that information. I haven't got it on me,
okay.
But I can certainly, if somebody can provide me with the person's details who wants the information, I can certainly send that through. Or she can email me direct if she wants to.
There we go. Yeah, we'll get that and share that across to you then shortly, Marie. Thank you for that. So very quickly then, just to wrap up, can I ask each of you what has been your favourite deal that you funded recently? Ian, do you want to start us off?
Right, good question. We're not quite funded it yet. We're on the home straight, so it'll be happening very soon. Probably been working on it for 3 or 4 weeks now. It's a four unit executive homes, 4 detached homes. Considerable size, nice location right on the edge of the green belt. They agreed a purchase price for the site. They've since, well, they advised to us it was a pre-sale, and what the buyer was actually looking to do was purchase the plot. And then they wanted to know how we could structure that into the transaction. So the purchaser of the plot would then engage our borrower as a contractor to build out the home. For them to ultimately move into, but they will be the owner of the plot during that build. So they've agreed a price for the plot, which is more than the individual plot value attributed to the purchase. So it's more than a quarter of the purchase price effectively. So what we've been able to do is allow them to get some cash back and cash flow effectively from that plot sale. And by then them building that out for the plot owner, they will receive monthly stage payments, which will include effectively their developer's profit. So they're advancing the developer's profit and they're getting cash flow into the business over and above what they would normally, rather than waiting right at the end. So then we're focusing on the other 3 units and providing 75% of global costs on that. You know, I think they spoke to their existing lender who really was struggling to support it. They see the cash flow benefits, they like our commerciality. The deal works for us, so we just saw it as a win-win and just a bit of thinking outside the box.
Excellent. It looks like a really nice structure to that deal as well, which helps out every party. Excellent. Peter?
Well, the best deal so far is the next one, I would say. So bring on the next deal, what I would say to that one. So yeah, in seriousness then, we helped a client purchase an asset that was on a wealthy suburb in Manchester. It was in a state of disrepair, hadn't been used for a number of years. It was kind of a landmark building. It's got history to it. It's got a grade 2 listed Visage at the front. The applicants were reasonably local. So once we got the phone call, we met the applicant on site with their broker. They brought along their professionals, and we kind of brought that ambition and aspiration to life by having a walk around the site and was talking to the architects, see what was going to happen and what they wanted to do. He came with planning risks because it didn't quite have planning for what they wanted to do. But we ended up helping them buy the asset in, and we're now discussing development funding to convert it into some nice apartments. So yeah, that's quite good. Historic building, landmark building, not been used for a while. Local kind of applicant. Yeah, that was probably the one for me this year so far.
Nice, thank you. It's nice with development in particular where you can see something from what it was to what it's going to go into, and then be involved in that process. It's nice. Yeah. Adam.
Again, I'll probably just talk mainly just about a development that I've currently just been able to get some terms on. So obviously, you know, it's all great fun and exciting to be able to fund you know, development deals for clients, but you know, it's just as fun and exciting to be able to secure terms, you know, initially for a client. So this is a large scheme in Camden. It's an old historic care home into 30 prime residential units. Once complete, the scheme is worth in the excess of about £80 million. Lends itself really well to the local area. You know, the targeted consumers, you know, stand up in terms of, you know, its own due diligence. And we've managed to secure, you know, we're near enough a £45 million facility to help the client, not just with the sort of senior debt that exists, but also to provide 100% of the bill cost. So, you know, amazing results. It's been, you know, good couple of months, you know, work, discussions with different lenders, site visits, conversations. But yeah, we're slowly making forward steps, and we're looking at that going live this summer. So we're really exciting.
Excellent. Well, gentlemen, we've actually overrun the allotted time on that one with all the quality content that was brought through there. So all that's left for me to say is a huge thank you for your time and expertise today. I'm sure that's been really interesting to everyone listening, as it certainly has to me. I hope all of the brokers in attendance picked up something new, and I look forward to some deals being made off the back of this. So thank you, gentlemen, for your time this morning.
Great to be part of it. Thank you.
Enjoyed it. Thank you.
So everyone, keep a lookout for the next in the series of Dealmakers webinars from Crystal Specialist Finance. And for now, thank you for tuning in. I look forward to seeing you all soon. Stay busy, stay safe, and I'll see you all next time.